In our last discussion, we explored the powerful benefits of using a trust. We saw how it can protect your family's wealth. We learned how it can help manage assets for your children. Trusts are a key tool for smart financial planning in Canada. They offer control and peace of mind for the future. Many people see them as a safe harbor for their hard-earned money. They believe a trust can shield their assets from many of life's uncertainties. This makes them very popular for estate planning. But setting up a trust is not a simple task. It requires careful thought and precise action. A single mistake can have serious consequences down the road. The Canada Revenue Agency, or CRA, watches trusts very closely. One mistake in structuring can expose your assets to CRA or creditor scrutiny. Every trust has three main roles. These roles are the key players in the story of your trust. It is very important to understand what each player does. The first role is the settler. The settler is the person who creates the trust. This is the individual who owns the assets and wants to put them into the trust for a specific purpose. You, as the person setting up the plan, are the settler. You are the one who starts the entire process. You decide the rules and the purpose of the trust from the very beginning. The second key player is the trustee. The trustee is the legal manager of the trust. This person or company holds the legal title to the assets inside the trust. Their job is to manage those assets according to the rules you set out. They must act in the best interest of the beneficiaries. A trustee has a very high level of responsibility. This is called a fiduciary duty. It means they must be honest, loyal, and careful. Choosing the right trustee is one of the most critical decisions you will make when you are planning. The third and final player is the beneficiary. The beneficiaries are the people or organizations who will benefit from the trust. They are the reason the trust was created in the first place. This could be your children, your grandchildren, or even a charity you support. The beneficiaries receive the income or the capital from the trust assets. The trustee makes these distributions based on the instructions in the trust document. The beneficiaries are the ones who ultimately receive the financial advantage provided by the trust's assets. These three roles must be separate and distinct for the trust to be valid. The settler gives the assets. The trustee manages the assets. The beneficiaries receive the benefits from the assets. If one person tries to be all three, the trust may not be recognized by the law. The CRA might see it as a sham. For example, you cannot be the only trustee and the only beneficiary. This separation of roles is a fundamental rule. It ensures that the trust is a real and independent legal arrangement, not just an extension of yourself. In this article, we will walk through the essential steps. We will cover how to set up and manage a trust correctly in Canada. We will look at the key people involved. We will discuss the legal document that creates the trust. We will also talk about the tax rules and legal warnings you must know. The trust deed is the most important document for your trust. It is the legal blueprint that contains all the rules. This document is also sometimes called a trust agreement or a declaration of trust. It explains exactly how the trust will operate. It names the trustee and the beneficiaries. It lists the assets being put into the trust. It also describes the trustee's powers and trustee's responsibilities. The trust deed controls everything the trustee can and cannot do with the assets held in the trust. It is the constitution for your trust. You should never try to write a trust deed on your own. Using a template you find online is also a very bad idea. These documents are often too simple. They may not be valid in your province. They might not achieve your specific goals. A poorly written trust deed can be challenged by the CRA. It could also be challenged by a creditor or an unhappy family member. A small mistake in the wording can lead to big legal battles later on. These battles can cost your family a lot of money and stress. To create a strong and effective trust deed, you must hire a professional. You need a lawyer who specializes in estates and trusts. An experienced tax lawyer is also a very good choice. This expert will listen to your goals. They will ask detailed questions about your family and your finances. They will then draft a custom document that fits your exact situation. This ensures that the trust is legally sound. It also makes sure the trust will accomplish what you want it to, such as protecting assets or minimizing taxes. Working with a lawyer is an investment in your family's future. The lawyer will make sure the trust complies with all provincial laws and federal laws. They will help you choose the right trustee. They will clearly define the rights of the beneficiaries. A professionally drafted trust deed provides clarity and certainty. It greatly reduces the risk of future problems. It is the foundation upon which your entire plan rests. Do not cut corners here. A solid legal foundation is the only way to build a trust that lasts. When you create a trust in Canada, you must choose a province to govern it. This is called the trust's jurisdiction. The laws of that province will apply to your trust. This is an important decision. Each province has slightly different rules about trusts. These differences can affect how your trust is managed. They can also affect the rights of your beneficiaries. For example, some provinces have laws that give more protection from creditors. The province you choose does not have to be the province where you live. It also does not have to be where your beneficiaries live. You can choose the jurisdiction that offers the best legal framework for your goals. For instance, Alberta has specific trust legislation that is often seen as favorable. Other provinces may have different advantages. A lawyer who specializes in trusts can help you compare the laws in each province. They can advise you on which jurisdiction is the best fit for your specific needs and your long-term plans. The choice of jurisdiction is established in the trust deed. The document will state something like, "This trust shall be governed by the laws of the province of Alberta." This clause is very important. It tells the courts and the CRA which set of rules to apply. You also need to make sure the trust has a real connection to the province you choose. This usually means having at least one trustee who lives in that province. This helps prove that your choice of jurisdiction is genuine and not just for show. Making the right choice of province from the start can save you a lot of trouble later. It can add an extra layer of protection for the trust assets. It can also provide more flexibility for your trustee in managing the trust. This is not a decision to be made lightly. It requires expert advice. Discuss this topic carefully with your estate lawyer. They will help you understand the pros and cons of each option. This will allow you to make an informed decision that strengthens your overall trust strategy. Section 5. Bringing the trust to life. How to fund it correctly. A trust is just an empty legal shell until you put something in it. The act of transferring an asset into the trust is called funding or settling the trust. This is the step that brings your trust to life. To do this correctly, you must legally transfer ownership of an asset from yourself to the trustee. This is a formal process. It requires proper documentation. You cannot just say that an asset is now in the trust. You must prove the transfer happened legally and officially. The first step is to choose the settlement asset. This is the very first piece of property that goes into the trust. It can be a small amount of cash, like $10. It can also be a more symbolic item, like a gold coin. It can also be a more symbolic item, like a silver coin. The important thing is that something of value is given. You, the settler, must physically give this asset to the trustee. The trustee must then provide you with a receipt. This receipt is a critical piece of evidence. It proves that the trust was properly settled on a specific date. After the initial settlement, you can transfer other, more significant assets into the trust. Real estate investment portfolios, shares in a private company. Each type of asset has its own legal transfer process. For real estate, you must change the title deed to name the trustee as the new legal owner. For bank accounts or investments, you must work with the financial institution to change the ownership on their records. Every transfer must be documented with legal paperwork. Keep copies of all these documents in a safe place. The timing of these transfers is also very important. The trust must be legally created and settled before any major assets are transferred into it. You cannot backdate these actions. The documents must reflect the actual dates when the transfers took place. Failing to follow these steps can make the trust invalid. The CRA or a court could decide that the assets were never truly given to the trust. This would defeat the entire purpose of your planning. Be precise and be thorough with your paperwork. Section 6. Staying on the right side of the CRA. Tax rules for trusts. Once your trust is created and funded, it becomes a taxpayer in the eyes of the CRA. This means the trust has ongoing tax responsibilities. The most basic requirement is filing an annual tax return. Most trusts in Canada must file a T3 trust income tax and information return each year. This is similar to the T1 personal tax return that individuals file. The T3 return reports all the income the trust earned during the year. It also reports how that income was distributed to the beneficiaries or kept in the trust. Another very important tax rule is the 21-year deemed disposition rule, visual calendar page showing a 21-year cycle with a large dollar sign and a CRA logo at the end of the cycle. This rule is designed to prevent assets from staying in a trust forever without ever being taxed. Every 21 years, the trust is treated as if it sold all of its assets at their fair market value. This can trigger a large capital gains tax bill. Your trust must plan for this event. You may need to distribute assets to beneficiaries before the 21-year anniversary arrives. Proper planning can help manage or defer this tax. If your trust holds foreign assets, there are extra reporting rules. If the total cost of the trust's foreign property is more than $100,000 CAD, you must file a special form. This form is the T1135, Foreign Income Verification Statement. This applies to things like real estate in another country, or stocks in a foreign company. The penalties for failing to file this form are very high. The CRA is very strict about this requirement. It is crucial that your trustee is aware of this rule and files the form on time every year. Compliance with these tax rules is not optional. The CRA has increased its focus on trusts in recent years. They have new, more detailed reporting requirements to gather more information. Your trustee must keep perfect records of all income expenses and distributions. They should work with an accountant who has experience with trust taxation. Following the rules carefully ensures your trust remains in good standing. It protects the trust from audits, penalties, and legal challenges from the tax authorities. It is a key part of responsible trust management. One of the main reasons people use trusts is for asset protection. They want to shield their wealth from future potential creditors. However, there is a very important legal limit to this protection. You cannot use a trust to hide assets from your existing creditors. If you already owe someone money, you cannot transfer your assets into a trust to avoid paying them. This action is known as a fraudulent conveyance. It is against the law in every province in Canada. The law is designed to be fair to people you owe money to. If a creditor can prove that you moved assets into a trust with the intent to delay, hinder, or defraud them, they can ask a court to reverse the transfer. The court can declare the transfer void. This means the assets are brought back out of the trust. They become available to the creditor to satisfy your debt. The protection you thought the trust provided will completely disappear. The trust will be undone as if it never happened for those assets. Canada's Bankruptcy and Insolvency Act also has powerful rules about this. If you declare bankruptcy, a bankruptcy trustee can look back at your past transactions. They can challenge transfers made to a trust several years before the bankruptcy. If you transferred assets for less than fair market value, the transfer can be reversed. This is especially true if the transfer happened within 1 to 5 years of your bankruptcy. The rules are complex, but the message is simple. You cannot use a trust to cheat your creditors. To avoid this problem, it is best to set up and fund your trust when you are financially secure. This is called planning in sunny weather. You should create your trust when you have no existing legal claims or major debts hanging over your head. This shows that your intention was to do prudent family planning, not to avoid a specific debt. Documenting your healthy financial situation at the time you create the trust is a wise step. It provides strong evidence that your motives were proper and legitimate. For a trust to be effective, it must be real. This means the settler must truly give up control of the assets to the trustee. If the settler continues to treat the trust assets as their own property, the CRA can declare the trust a sham, or a court can declare the trust a sham. A sham trust is a trust that only exists on paper. In reality, it is not a separate legal arrangement at all. It is just a disguise for the settler's personal assets. A sham trust provides no tax benefits. A sham trust provides no creditor protection. It is completely useless. The most common reason a trust is found to be a sham is a lack of trustee independence. The trustee must be the one making the decisions. They must manage the assets according to the trust deed, not according to the daily instructions of the settler. If the settler is constantly telling the trustee what to do, it suggests the settler never really gave up control. For example, if the settler calls the broker to make trades for the trust's investment account, that is a major red flag. To avoid this, the separation of roles must be respected in practice, not just on paper. The settler sets up the rules in the trust deed and then must step back. The trustee must take charge. The trustee should hold separate bank accounts for the trust. They should make investment decisions independently, perhaps with advice from a professional advisor. They should keep detailed records of all their decisions and actions. These actions demonstrate that the trust is a genuine and separate entity. Let's look at a real-life Canadian case to see how things can go wrong. There was a dentist in British Columbia who wanted to protect his assets. He was worried about potential lawsuits from his dental practice. He decided to set up a family trust. He transferred assets into the trust family home. Other investments. His wife was the trustee. He was a beneficiary. His children were beneficiaries. On the surface, This looked like a standard asset protection plan. He thought his assets were now safe from any future claims. Years later, the dentist's business ran into financial trouble. He owed a significant amount of money to a creditor. The creditor sued him. When the creditor discovered the transfers, they challenged it in court. The creditor argued the trust was not a real trust. They claimed it was a sham designed only to hide assets. The court had to look closely at how the trust was managed over years. The court found the dentist treated the assets as his own. He lived in the house, paid no rent to the trust. He used money from the trust's bank account, personal vacations, personal expenses. His wife, the trustee, did not make independent decisions. She signed whatever documents he asked her to sign. There were no proper trustee meetings or records. It was clear the dentist was still in complete control. Because of this evidence, the court agreed with the creditor. It declared the trust to be a sham. The judge ruled he never truly gave up control of his assets. Therefore, the trust was invalid. The house and investments were treated as if they still belonged to the dentist. The creditor was then able to seize those assets to pay the debt. This case is a powerful warning. Just having a trust document is not enough. You must operate the trust correctly and respect the independence of the trustee every single day. We have covered the essential steps for setting up a trust correctly in Canada. We started by understanding the risks from the CRA. Creditors. We identified the three key players: the settler, the trustee, the beneficiary. Hire a lawyer to draft a professional trust deed. Choose the right provincial jurisdiction for your trust. These foundational steps are the bedrock of a successful and resilient trust plan. Getting them right is everything. Next, the practical mechanics of managing your trust. Properly fund the trust. Legally transfer assets to the trustee. Tax compliance rules. The T3 return. The 21-year rule. Foreign asset reporting. The BC dentist case showed real-world consequences. In our final episode, when tiu tapen tanster, we be Weinstein will explore our non-full advanced strategies, including offshore options and multi-generational planning.